units during the week. Now, the management of the energy giant visited the NSE to intimate the stock trading community with the latest developments in its first quarter earnings that increased by over £1 billion. I had a chat with the group chief executive, Mr. Wale Tinubu, on how the company retreated into profitability and his projections for the oil market. Let's listen.
It suffered from the collapse in the oil prices. The oil prices dropped from $100 an average to $30 per barrel. It's recently recovered to around the $50 mark. And Rwanda had quite a bit of debt. We had extensive projects across the midstream, the upstream, and the downstream. And the first thing we had to do was enter into a 5-point restructuring agenda where we sold down some of our assets. We raised over 120 billion naira in cash to reduce our debt. We also restructured our loans, and the net debt after we paid down, we booked a 5-year, 15% per annum loan with the banks. We converted quite a lot of debt into equity and effectively had a leaner balance sheet to ensure that our cash flows supported our cost base and our capital base. So far, we focused on expanding our dollar-denominated earnings by increasing production on our upstream assets, by focusing extensively in the export of crude, which we've done successfully, and we've done quite a lot of importing of petroleum products, and we've imported a substantial amount of products. We've done over 13 million barrels of crude on the export side, and on the import side, we've done a substantial amount of volumes into the country, and we still continue to do so.
Given the recent relapse in oil price and the fact that OPEC members are considering an extension of oil production cuts, what's your outlook for the crude oil markets?
First of all, we almost realize that oil is a commodity like any other commodity, so the price will change from time to time. We just had a period between 2009 and 2014 of superb growth. But the truth about the matter is that when you have a downturn like we've had, there's been a substantial amount of reduction in investment. That reduction in investment fails to replace what has been consumed. And what has been consumed on a day-to-day basis is declining by anything from 9 to 15% per annum. It's a range. Oil produced, you start a well, you're producing 100%, it will decline naturally until it gets to zero over a period of time, except you reinvest in the field by drilling additional wells.
Nigeria's Capital Markets Committee is now joining efforts to see to the ease of doing business in Nigeria. At the first quarter meeting held in Lagos, the Director General of the Securities and Exchange Commission, Mr. Munir Gwazo, explains plans to reduce issuers' time to market and transaction costs, as well as the need to mandate the direct cash settlement requirement for investors by September 1. So let's quickly take a look now at some of the figures that we had from the markets, the equities and debt side this week. It was a record-breaking week at the equity market this week as the all-share index notched up the heaviest gains since June 2016, posting the largest singular gain of 7.46% week on week and setting a 9-month high record at 28,423.70 points. The market capitalization advanced in the last 10 trading sessions, extending gains to the third straight week to close at 9.7 trillion naira. Analysts attribute this week's record gain to demand for blue chip stocks across board, most notably the banking and consumer goods names. Let's look at the FMDQ OTC as well as the NASD OTC. The debt market, FMDQ performance in the domestic bond markets picked up this week as yields trended southwards on all trading days of the week, except for Wednesday. But the figures you have right now on screen reflect the trading data for yesterday, Friday, where March, June, and March 2036 securities in terms of bonds had the sentiment of investors. On the T-bill side, we had 539 dues and 150.04 billion naira was the value of all that came in. In terms of the NASD OTC markets, the USI also went as high as 0.60% with a market capitalization settling at 396.78 billion naira. There on the screen you have the details of the year-to-date performance in terms of trades, volume, as well as value. Let's now get back to what we've been looking at, the passage of the 2017 appropriation bill by the National Assembly. The president of the Association of Advancement for the Rights of Nigerian Shareholders, Dr. Farouk Umar, joins us now all the way from Kano to take a look at the impacts of this budget that has just been passed for the Nigerian capital market. It's really a pleasure for us to have you on Capital Markets. Thanks for coming, sir.
Thank you very much.
So give us a sense of what this means for you as a shareholder, as an investor in the Nigerian markets.
Well, it means a lot. First of all, this year there are many projects that will be executed. If you take the cement industry, they are going to benefit tremendously from the budget. And as such, I believe shares of Dangote Cement, Lafarge, Ashaka, CCNN will go up. We have already seen, for example, WAPCO, even before the passage of the budget, from 35 naira it has gone to 48. Secondly, improvement in electricity.
Yeah.
Means a lot to us. So in the budget you will see that this year we are hoping electricity supply will improve. You see the Gen course and the discourse, for example, Transcorp bought into Ogeli generating plant.
Yeah.
Then security-wise, you see companies like Nestle.
Those are some of the bellwethers that have actually started taking, bringing investors, especially the foreign portfolio investors, back into the market. I agree with you.
Yeah.
And do you agree with these comments that it is because Nigeria needs to exit recession that the budget was quickly passed by the National Assembly?
Well, I think that could be one. And secondly, I think the executive is trying to now be harmonious with the National Assembly.
All right, Doctor, thank you so much. Of course, you're still on the show, and we'll be coming back to you after the break to take a look at how your investments, what you expect it to look like under the current state of the market, where we are now seeing the returns of foreign investors. That's after the break. Don't go away.